Hi, welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Hall Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, we are covering private markets reporting, and in the roundup, we'll cover some recent news out of the US Endowment performance tables and some interesting staff moves in the Australian family office market.
This is the Family Office Sherpa.
First up, private market reporting, one of my favourite topics. And to be honest, one of those topics that I'm getting asked a lot about. I have a lot of conversations recently with clients, contacts, really anyone. And I'm not sure why it is, but it seems to be potentially we've hit a use case for the private markets. I mean, private markets, as in obviously the difference between private and public, being private is, not on exchange, basically. So what we're talking about really a lot of the time is reporting on that private market investments. Heavy users of private markets within the family office structure. So you can imagine there's quite a topic of conversation. I have no idea why it's just becoming increasingly topical. I think just the sheer volume of information that seems to be coming up now has meant that it's front of mind for a lot of people. So what are we talking about here? So private market investments really are those that come with an investment portal. So private market investments often come with an added reporting burden, which is that it's very manual. It's not exchange where you just get a price coming from the exchange or, good bond markets or like liquid bond markets where they just give you a pricing, or the reporting infrastructure you've got in place will just be able to draw down that daily net asset value or daily price. So there's a significant amount of conversations recently with officers around the new technology. Shaun, what's the new technology? What's the technology that you're using or your family office clients are using to manage that manual process or to get rid of that manual process? And there's a lot of technology that are coming out now that purport to solve this issue which is the main issue, which is aggregating all those data sets and reporting across them, getting some aggregation and then reporting. One of the reasons we decided to do this on the podcast is there was a recent SS&C report on private markets. And one of those, disregarding sort of the trends within the actual investment side, I, as always, sort of dig down more into the data aggregation and the operational pieces, which is one of the points was that LPs, so limited partnerships, are increasingly seeking a unified platform to monitor their entire portfolio, especially as they diversify and cultivate more GP relationships. So they quote 68% already leverage technology for portfolio monitoring, but that is just the technology. Most express the need for improvement in aggregating data across those multiple funds into a single platform, and massive 81% said that would be a beneficial thing. So you get all that aggregate. They're using technology already, but obviously, by those two data points, it shows that 81% saying it would be super beneficial if we could aggregate it all into one place and automate it, I'm assuming. Now, like I said, I'm not going to get into the benefits of the asset class per se here, but what I'm talking about is that family office, and the reason why I'm talking about this is because family offices and their advisors are increasing their use of private markets. There's no data out there from all the reports that continually come up that people are reducing or moving away from private markets. If anything, they're increasing. So, which brings us down to the trickle effect of pulling the trigger on that 5, 7, 10-year lockup fund with fund manager, whoever, that you now have to deal with. So, I start on a process point here. So what should have already happened before you pull that trigger, right? Operational due diligence has been done, hopefully, especially including those that are going to administer these investments. Great on the investment side, but we're not talking about the tail wagging the dog, but what we're talking about is understand the impact of that investment. So pulling the trigger. So are we using an intermediary? Right, a private bank, wealth manager, and can they provide the updates for that portfolio, for that fund manager? And can they move that into our reporting infrastructure? What I mean by that is if we're using private bank A, they get us into investment A. Are they going to do the heavy lifting on the administration of that private market investment, or is that up to us now? And do we have to get that into our reporting infrastructure? Usually, that's up to us. So just be mindful of that. So if you're investing directly, so i.e. not directly with the manager, does that manager provide access to investment portal where all the documents are aggregated? Often, yes, right? I mean, if they're a manager of some size and repute, then they should have, they'll give you a login. It's usually an email address and then login, and then you go, oh, okay, great. Now there's another platform or another login that I have to deal with and we have to manage and things like that. So, these are the things you need to be concerned about. Also, when, we are uploading this into our own reporting infrastructure, what does that look like? Do they deliver it in PDFs? Is there some sort of integration? Usually no. So when we have that initial committed capital, are we pacing? Is there any sort of versions of software that can help it? And are we mapping it correctly? These are the sorts of things that we need to understand. And once we start to receive capital calls, we're going to, is it going to be easy to reconcile against the bank account and also the general ledger and our incumbent investment reporting? And what does ongoing maintenance look like, right? So this is the real challenge. And I guess this is why people keep asking me around, well, what does the technology look like here? Because they're trying to get rid of some of this very manual ongoing maintenance. And this is the real the real sort of ongoing issue for a lot of family offices, which is sometimes it takes a significant amount of internal resources to manage these. And it's not even the portfolio management, it's the administration management. So let's break it down. There's around sort of 4 things that we look at here. So portal access. Are you going to do this yourself or are you going to have someone else do it for you? And this is a question for the technology piece, right? So what are we trying to fix here? If we want someone to do it for us, and an intermediary can't do it for us, then what's the technology that can? And if the technology can do it, can it do it by itself, right? So what does that portal access look like, and what does that letter of, that authority piece with intermediaries look like? What is number 2? Reconciliation. Once the capital calls start, once that committed capital piece is in place, and bank accounts start, transfer out of the bank accounts and things like that, how is that going to be uploaded and read? How is it going to be ensured that it's accurate between things like the general ledger and the investment book record? And who's performing this task? Are we getting someone internally to do it? If we're going to someone internal to do it, that could raise resourcing challenges. Can the technology that we've decided to use, if we have decided to use technology, can they be relied on to map this correctly and get all the reading of the PDFs and things like that? Have we got confidence that that is going to actually be accurate as well? Or are we going to have some manual oversight or manual reconciliation? Is it going to include the pacing within the technology as well? So the pacing software sometimes comes as a separate platform that integrates with another one, or it might come under that same login within the same technology. So, and are we going to manage that pacing of distributions and capital calls and things like that? And number 4, costs. Are we doing a cost-benefit analysis here to determine the time spent by, like I said, well-credentialed staff performing data entry? And even then we start to see errors as well. So I guess this is the thing that again, going back to that, is the technology there? Question, is the technology going to reduce staff manual entry hours, which can be a punish? Is it going to reduce the need for significant amounts of reconciliation? Like, can you trust its ability to read those PDFs and under usually a letter of authority, take that data set out of the investment portal? Or is it going to cause more issues, right? Is it going to cause more reconciliation issues? All that sort of thing. So these are the things that we need to worry about from an ongoing maintenance point of view. And the third one is the third sort of part of this section, which is the portfolio management. When you're a portfolio manager here, these are the questions you sort of got to ask around the private market administration, which is, are we getting an aggregate view of the portfolio itself? Or are we having to try to guess in terms of, not guess, but certainly look at an Excel spreadsheet or some sort of version of our current reporting structure and go, yeah, that looks right. I don't have 100% confidence I know exactly what we're exposed to here, but in aggregate, I think we're in the right direction. Or do you want really specific, accurate data sets that can show you exactly where the portfolio is, what it's exposed to. And like that's to another point, which is how much clarity do you have on that exposure? So some technology will aggregate the data set, but it won't dig into the actual underlying. When I say dig into the data set, I mean it will get the distributions or the capital calls and things like that, but it won't actually provide any insights into the actual investments themselves. So when you look at technology, should you be looking at what level of detail they've got in terms of their own data set? So can they show you what the portfolio companies look like in the private equity portfolio or the venture capital portfolio? Or is it more broadly, like geographical, vintage sector, stuff like that? So I guess that goes to that question around technology, and if you believe that it can actually do the job, testing it at the, what sort of data sets do they have themselves that we can utilize? And the other part of that is going to be how you benchmark it. Like, how do we benchmark it appropriately? So if we get real clarity into underlying constituents and we get not real-time data, but data that's really as up-to-date as it can be in this private market sector, then we can really improve our benchmarking. We can make it more accurate and more responsive as we add more investments and take off investments as they mature. And what are the advantages of the inbuilt data sets of that technology platform as well? Will the platform provide insights into the funds that is unique to us? There's a lot of talk around AI and things like that. I think one of the big parts of what they continue to talk about when it comes to AI is the utilization of unique data sets that we as an investor can put into our own portfolio management systems. So if they have fund manager A and they have that same fund across 40, 50, 100, 200 clients across different lines, then you go, well, surely we can get some insights from that. And they do purport to give you those sort of insights. So that's what I'm looking at. That's the questions we're asking around private market administration. It's the sort of thing that I keep getting asked about, so it must be front of mind to a lot of people. That SS&C report, I'll put it in the show notes because it's quite interesting and it does show you some of the data sets. The thing it doesn't really talk about is sort of the cost. Like for those looking at these providers that just say we can manage the private market administration, look at the way that they charge on fees. It's not the same as you would probably get with platforms and things like that. They tend to do it by the line, so by each asset over the year. And just look out for some things that are multi-currency, non-multi-currency, things like that. So really have a dig into it. If you're interested in understanding more about it, flick me an email because it's, like I said, it's something that we're really looking at for clients on the reporting side. So yeah, hopefully that was enjoyable. Now, on the week roundup, 2 interesting things that I found anyway. Like I said, the staffing moves. CH Woolman out of Sydney, which is a family office, has picked up a really good portfolio manager from Colonial First State. Now, the reason I highlight this is A, because it's someone going to a family office, and B, we start to see a little bit more of those institutional multi-asset class portfolio managers starting to be picked up by family offices looking to really pull in some professionalisation. We're starting to see that across the board. I do get asked quite a lot, actually, by sort of institutional asset management types and portfolio managers if family offices are a place that is attractive. Again, it really is going to be determined by the family office themselves and the individual. And, it's a very flat structure as opposed to Colonial First State, which is a big shop. So being ready for that difference as well. Again, always happy to chat to people about sort of what that looks like. And the other one as well, now it was on this recent article on Bloomberg, which is around the performance data that comes out of the university endowment, so the university league table, for want of a better term, like how well they've performed. One of the ones that was highlighted in the article was Michigan State and their endowment, and they had some really good recent performance. Like I said, I'm always interested in the university performance reporting because there seems to be a big overlap with family office investments through the cycle because, as in previous podcast episodes, I've sort of mentioned that endowment model, which a lot of family offices do either follow or claim to follow. And so finding out those universities that report, and they often dig into the asset mix. So for Michigan State, they had a significant amount of exposure to US equities. And so the recent performance of those US equities, public markets, has meant that it's outperformed because of that. Now, will we continue to hear about this performance if US equities start to underperform? No. But I think what it highlights is that if you've got a strategy, family office, endowment, or otherwise, and you stick to it, you should know how you will perform during different parts of the cycle. And the patient capital here, which endowments and family offices both have, means that if you pick the asset class that you want to be overweight in, or you have a bias to, or whatever, it might be public markets, it might be private markets, like you saw with the sort of the Swenson model with Yale and Harvard and things like that, then you just understand the expectations during the cycle. Right. And I think that's a really important thing. I think it's a good article. I think it highlights the difference in the way that you invest money. But ultimately, if you looked at it over a 10-year period rather than a 1-year period, you'll start to see where those different investment styles outperform and underperform, and same with family offices. So, like family offices, endowments, long-term returns, and a very big focus on downside reduction. So, always interesting. I'll link those two articles in the show notes. Hopefully this was of interest. As always, you can get me on Shaun at hallroad.com.au. I'm on LinkedIn. I'm quite active there. And if you're interested in subscribing to the the Family Office Sherpa newsletter, which covers similar kind of things but a little bit more detail, then that's at hallroad.com.au as well. If you see this podcast on Spotify and Apple, please click the follow, the little bell thing. If you can give me a rating, that would be awesome too. And if you think anyone else might be interested, then please let me know. Until next time, thanks very much.